Hello, financial explorers! Welcome back to Investing Lighthouse, where we bring you fascinating tales from the global world of finance. Today, we're pulling back the curtain on the mysterious, often misunderstood realm of hedge funds. Let's grab our financial compass and navigate the hedge maze together. A hedge fund is a type of investment vehicle and a business structure that combines capital from accredited individuals or institutional investors and invests in various assets, often with complex portfolio construction and risk management techniques. The term hedge fund originated from the practice of hedging risk by offsetting potential losses using a variety of investment approaches. But don't be fooled, folks. Today's hedge funds can be just as focused on maximizing returns as they are on mitigating risk. Like a character from a mystery novel, hedge funds are often vilified, with the reputation as financial market villains. But why the bad rep? Let's dig into some historical events that painted hedge funds in a negative light. One of the infamous episodes involves long-term capital management, LTCM, in 1998, with two Nobel laureates on its team. LTCM was the star child of the hedge fund world. However, when the Russian financial crisis hit, LTCM's risky strategies that relied on excessive leverage led to a downfall so severe that it threatened to disrupt global markets. This required a $3.6 billion bailout by the Federal Reserve and other major banks. Another notorious episode is the 2007-2008 subprime mortgage crisis. Hedge funds, loaded with complex financial instruments like mortgage-backed securities and collateralized debt obligations, amplified the market crash. When the housing bubble burst, hedge funds like Bear Stearns lost billions, intensifying the financial turmoil. These events, among others, have led to the perception of hedge funds as high-risk, disruptive forces in the financial market. However, it's essential to remember that while some hedge funds have contributed to market volatility, not all hedge funds are the same. It's like saying all apples are sour just because you bit into a sour one. Despite the controversies, hedge funds play an essential role in our financial markets. They provide liquidity, aid price discovery, and help make markets more efficient. By identifying mispriced assets, hedge funds help drive prices to their fair value, ensuring no free lunch is left on the table. Now, what makes hedge funds different from your typical mutual funds? Well, it's like comparing a racing car to your everyday sedan. Both can get you from point A to point B, but the former does it in a more thrilling, albeit riskier way. Hedge funds have fewer restrictions on what they can invest in. They can go long or short, use leverage and derivatives, trade in distressed securities, and even invest in real estate or artworks. In contrast, mutual funds have regulatory constraints that prevent them from taking on certain levels of risk. Now, folks, let's shed some light on another peculiarity of investing in hedge funds: restrictions on fund withdrawals. If you're a traditional mutual fund investor, used to withdrawing your money anytime you like, welcome to a different ballgame. Hedge funds often have locked-up periods, a span of time during which investors cannot withdraw their funds. Depending on the fund's strategy, this can range from a few months to a couple of years. Also, there are often redemption windows, specific times when investors can take out their money. But why these restrictions, you may wonder? Hedge funds often invest in less liquid assets or use complex strategies that take time to pay off. They must ensure they have the funds to stick to their strategies without being forced to liquidate assets at the wrong time because investors want their money back. Imagine being at a poker game, and just as you're about to win, your fellow players want their bets back. That's a no-go, right? Similarly, hedge funds need time and stability to execute their strategies. But it also means that investing in hedge funds requires a certain level of patience and risk tolerance. So if you're the type who likes to have your cash accessible at all times, a hedge fund might not be your cup of tea. But who can actually invest in hedge funds? Well, it's not a playground for everyone. It's like an exclusive club where the entry fee is high and the drinks are potent. To invest in hedge funds, one needs to be an accredited or qualified investor, meaning they meet specific income or net worth thresholds. For US retail investors, you'll need a net worth surpassing $1 million, excluding the value of your primary residence, or an income of at least $200,000 in each of the last 2 years. As for institutions like pension funds or university endowments, they need at least $5 million in investments. But remember, high entry barriers don't equate to guaranteed profits. As we've seen from past events, the risks in hedge funds are real and can be substantial. Hedge funds are like financial chameleons. They adapt their investment strategies based on market conditions. Here are some of the popular strategies they use. First, we have long-short equity funds. This is where hedge funds go long on undervalued stocks and short ones that are overvalued. For example, a hedge fund may go long on tech startups, while shorting established tech companies, hoping to profit from the market dynamics. Then we have global macro funds. These funds bet on macroeconomic trends using currencies, bonds, and commodities. George Soros' infamous bet against the British pound in 1992, which earned him $1 billion, is a classic example. And our last example for today is event-driven funds. These funds focus on corporate events like mergers and acquisitions, bankruptcies, or spin-offs. An example would be buying a company's stock that is a takeover target, hoping to profit when the takeover happens. The fee structure of hedge funds can be pretty lucrative for fund managers. Traditionally, hedge funds follow the 2 and 20 model, a 2% management fee on assets and a 20% performance fee on profits. This structure has been criticized as it can encourage excessive risk-taking. But hey, no risk, no reward, right? Talking about hedge fund performance, folks, it's a bit like a treasure hunt, but the map is optional. Unlike mutual funds, hedge funds aren't required to disclose much information about their performance or holdings. You might find this surprising, but it's true. Transparency isn't really a strong suit of the hedge fund industry. We have databases like Barclay Hedge and Hedge Fund Research, which aim to shed some light on the performances of these elusive funds. But here's where it gets even trickier. These databases primarily rely on voluntary reporting from the funds themselves. Now, if you were running a fund and it was having a terrible year, would you want to shout that from the rooftops? Probably not. This voluntary disclosure leads to a phenomenon known as survivorship bias. Poorly performing funds tend to vanish from databases or never appear in the first place because, frankly, who wants to advertise failure? This can skew the data to make it look like hedge funds perform better on average than they actually do. So just like you wouldn't take a second-hand car salesperson at his word, don't take the average returns on these databases as gospel truth. There could be a clunker or two hidden in the mix. Always remember, folks, due diligence is vital in the world of investing. Before we wrap up, let's take a detour to a recent Wall Street drama that played out in real time. the GameStop Saga. It was a David versus Goliath story where an army of retail investors on Reddit's wallstreetbets forum took on the mighty hedge funds. The hedge funds had bet heavily against GameStop, a struggling video game retailer, by shorting its stock. But the retail investors orchestrated a short squeeze, buying up GameStop shares and driving the price up astronomically. This forced the hedge funds to buy back the shares at higher prices to cover their short positions, causing billions in losses. It was like watching a real-life financial thriller unfold. But here's a twist in the tale. Many retail investors believe they were sticking it to the big guys. But the reality is more complex. A substantial portion of investments in hedge funds come from pension funds, which represent the retirement saving of everyday workers. When the hedge funds incurred losses, the ripple effect reached the pension funds, indirectly impacting the people the retail investors thought they were defending. It's a good reminder that in the world of finance, every action has a reaction. And it's often more intricate than it seems at first glance. And that's it for our thrilling adventure into the hedge fund maze. Remember, while hedge funds can be exciting and potentially profitable, they aren't for everyone. But whether you're a hedge fund investor or a curious spectator, understanding their workings can make you a more informed participant in the financial world. We're eager to hear from you. So let us know what you think about hedge funds in the comments below. And if you enjoyed this journey, remember to subscribe to our channel, hit that like button, and turn on notifications for more financial explorations. Until next time, stay curious and keep exploring.